Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
Good morning, everyone, and welcome to Financially Raw. A new week has come and gone. It is the 20th of April, Thursday morning, the 20th of April, and I am looking forward to sharing the show with you this morning sometime, sharing some wisdom, some information, and today's topic is very, very interesting for me. It is about the pros and the cons, the risks, the costs involved in owning a property jointly with someone else. We tend to think that when we are married, we buy a property between the husband and the wife, and they register the property in both names. Or we move in together. We're young, we decide to move in together, and we want to buy a property, and we buy that property in both our names. What are the risks involved? What do we need to know that we safeguard ourselves in this event? And that's what today's topic is going to be all about. Today's show is proudly brought to you by Nexus X, our new venture where we offer entrepreneurs access to 10 experts in their field. They will work together to make your business achieve its full potential. So if you are interested, send an email to info@nexus-x.africa if you want to get some more information. If you are an entrepreneur, small business owner, and you do want to grow your business, take it to the next level. Also, as per usual, those of you listening on our Berg studio directly, we're going to have some music. Today's bands, we're going to have some Bee Gees, Duran Duran, George Michael, Whitney Houston. So we're going to share some nice music with you. Those of you on our social media channels, everybody on Facebook, LinkedIn, YouTube, and Instagram, what we're going to do is, while we're doing the music, unfortunately we can't play the music on the social media, we get blocked, but those of you watching, we are going to go through a video that I did, a show that I did a couple of years ago, I think it's about 18 months ago, regarding how to pay off your bond in half the time. We'll probably not get through the whole show, so if it's interesting, you want to learn more, please go to our YouTube channel, just search for I Retire on our YouTube channel, subscribe, like us, and you can then go search for that video of how to pay off your bond or your mortgage in half the time. There's 4 strategies that we teach, and I think that's something everybody needs to know. Now, before we get started, let's go to a quick music break, and we're going to play some music for you on Berg Studio. Those of you on social media, we're going to start the video on how to pay off your bond in half the time.
Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
So let's start, and before we start looking at the different strategies to pay off your bond in half the time, what we need to look at is, how do they calculate the interest on your bond? Because once you understand that, then you can start using the strategies to your advantage and use the fact on how they calculate the interest to your advantage. So when you buy a car, what typically happens is there's an interest rate at the beginning of the contract term. Let's say it is a 4 years or a 5-year term, a 60-month term. They will then calculate the total interest over the term. So they will calculate how much interest has to be paid over the 5 years. That interest portion then gets added to your total balance, and you then have a monthly payment plan to pay off that interest over the term of your car repayment. So let's say, for example, you buy a car for 200,000 Rand. They then calculate the interest. The interest might be 75,000 Rand over the 5-year term. They will then add that 75,000 to your loan, and you will have a balance of 275,000 divided by the 60 months that you are paying it, and that will be your monthly payment. So you will pay off the interest over the period, and the interest is calculated at the beginning of the loan agreement. With a bond, it works a little bit differently. A bond doesn't go and they calculate the interest when you take out the bond or you buy the house over the 20-year period and then add it to your bond. That's why for those of you who have houses, who has a bond statement, it doesn't show you 3 million if your house only bought the house for 2 million. It shows you what is outstanding, which is basically the capital outstanding. And how they work the interest on a bond is they calculate the interest on the outstanding balance every single day of your bond. And then at the end of the month, they take all those daily interests and they add it to your bond, and that comes off your payment first. So they will then go and, let's say for example there's 1 million rand outstanding on your bond today. The system or the bank, the computer system will calculate what the interest is. So let's say it's 10% of a million, that is 100,000 rand, divided that by 365 will then give you the daily interest. Tomorrow, if it's still a million rand outstanding, that same daily interest will be added up. And at the end of the month, they take all of these daily interests, put it together, and that is the interest that you pay for that month. So once you understand that a bond's interest is calculated daily and added to your bond once a month, you can then use that to your advantage. Because whenever you pay more into your bond, whatever the outstanding balance on that day is will have an effect on the interest that you pay for that day. So for people who have access bonds, if you can leave money in that access bond for a period of time, or you have some money sitting in a money market account at the moment and you can move it into your access bond, let's say you drop that by 50,000 rand by putting that savings into that access bond, every day the money lies in that account saves you interest. So how much interest do we pay on our properties? And because the term is so long, it is unbelievable how much interest we pay over a period of time. So I've done a quick calculation on one of our tools, our bond settlement calculator. And if you take out a bond for R1 million at a 7% interest rate, your repayment over a 20-year term will be 7,755 rand a month. So that will be your repayment. The interest that you will pay over that 20-year term is 860,000 rand interest on top of your R1 million that is outstanding on that property. So at the end of the day, that property that you bought for R1 million is going to be going to cost you 1.86 million rand. So just let that sink in. It's almost double of what you've bought that property for. So it's definitely in your best interest to try and get that down as quickly as possible, because the quicker you pay off that bond, the more interest you save. And you can go look at it. I mean, these days, R1 million, you might have a 2 million rand property that just doubles. Instead of 860,000, you now have almost 1.7 million in interest over your 20-year term. If you do it over a 30-year term, your repayment will be just under 6,700 rand per month, but your interest on that property will be almost 1.4 million rand interest. So your initial property of 1 million rand will cost you 2.4 million rand at the end of the day. So first and foremost, I don't suggest that people take out 30-year bonds. I mean, the savings that it gives you, which is about anything between 700 to 1,000 rand per million rand bond, is not going to be worth it against the amount of interest that you're going to pay over and above if you just do it over a 20. Welcome back, everyone, and that was ESP from the Bee Gees. Not a song that you hear that often, but I really do like it. And then those of you watching on our social media, we had a video on how to pay off your bond in half the time. Throughout the morning when we have the music breaks, I will play snippets of that video. And like I said before the music break, if you want to watch the rest of the video, you are welcome to go to our YouTube channel, I Retire, and go find that video there. We have over 300 videos on our channel, so content ranging anything from budgeting to insurance, everything that you want to know about finance. Today's topic is going to be all about jointly owning a property. So if you have any questions, you are welcome to contact me on our WhatsApp channel. I've got my WhatsApp open here. The number on that WhatsApp channel is sitting over there, 082-801-6693. You're welcome to send me a WhatsApp there. If you are listening on Berg Studio, there is a shout out button on the page. You can just click that shout out button, and here on my right hand side, or my left hand side, sorry, your right hand, I've got it open so I can answer your questions if you have any questions. So let's get going, talking about jointly own or joint ownership of a property. So there can be big advantages to buying property jointly, but you have to be aware of the risks and take steps to lessen them before you put pen to paper. Guys, it's always easier to get this homework done, get these things in place before you buy the property. You need to understand what the risks are and make sure that you are mitigating those risks. The problem comes in if there's a falling out with your co-owner, whether that is a romantic relationship, your husband, your wife, your girlfriend, boyfriend, or it's just a business partner, somebody that you bought the owner of the property through or with that person. Perhaps you come to blows on your usage of the property, or on the incurring of expenses, or on whether it is time to sell. Or perhaps you are splitting from each other entirely. So it's a relationship that broke up and you're just splitting up. That could be a business partnership terminating, or a marriage ending in divorce, or, as in the case we discussed, so we're going to do a little bit of a case study, a failed romantic relationship. Our courts must regularly resolve bitter joint ownership disputes between ex-spouses, ex-friends, ex-colleagues, siblings, and close relatives. None of who dreamed they might ever come to blows when they first hatched their plan to buy property jointly. So guys, you want to keep your things in place and put them in place in the beginning. You don't want to have these hassles, extra cost, stress when it comes to a breakup or some kind of a split. If a dispute does arise, how will you resolve it? And if you split up, who keeps the property? Or do you sell it jointly? And if so, how and when? How will the bond and other property debts be settled? So those are all the questions you need to ask yourself even before you buy the property. The good news is that by and large, the risk of dispute can be reduced with a bit of foresight and planning, preferably with professional advice and assistance. This is, after all, likely to be an important asset in both your estates. So let's look at, before we get into a lot more detail, let's quickly look at a High Court case study on what actually happened. A couple in a romantic relationship cohabitated in a house which they were the joint registered owners in undivided half shares. So each of them owned 50% of the property. When the relationship broke down irretrievably, the partners were unable to agree on a method of ending the property ownership. One partner moved out and the other, after changing the locks, applied to the High Court for an order terminating the joint ownership and appointing a receiver, a liquidator, to sell the property. So they wanted, the one partner wanted to sell the property. The other partner moved out of the property. The other party fought this application, contending that the couple had, in addition to being in a personal relationship, also been in a universal partnership which still existed. So the other party wanted to get their value out of the property as well. So a co-owner can normally insist on partition of the property at any time. So if you're a co-owner of a property, you can at any time insist on partitioning, of removing yourself from that property. The general rule in our law is this: no co-owner is normally obliged to remain a co-owner against his will. So you can ask to be removed as a co-owner on a property. Thus, every co-owner of property may insist on a partition of the property at any time. Even if there's an agreement to constitute perpetual joint ownership, the co-owner may demand partition at any time. So even if you had an agreement drawn up before time that says this property will be both the people's owners, in both people's ownership for forever, you can at any point demand partition. If the co-owners cannot agree on the way the property is to be divided, then the court is empowered to make an order which appears to be fair and equitable. That opens the door to a wide range of options for the court, but often it means an order for the sale of the property, possibly by public or private auction, and division of the net proceeds between the joint owners. Okay, so let's quickly take a short music break again, and then we'll come back and talk a little about whether it is bound or whether it is a free co-ownership. So the song we're going to listen to is Hungry Like the Wolf from Duran Duran. Those of you watching on YouTube or one of our other social media channels, we will continue with the video on paying off your bond. We'll be right back. 20-year period. Okay, so that is the first thing that you need to understand, is how the interest is calculated on your bond. So how do we get this bond paid off sooner? How do we make it so that you can pay off your bond in half the time? So there's three strategies. So the first one is easy. It is one that everybody knows. It's one that everybody can do, and that is to just pay in more every month. So let's say your normal bond repayment is 7,750 Rand a month. You add another 500 Rand or another 700 Rand or another 200 or even 100 Rand a month on top of that. Because every month you pay that comes off the capital directly. So it is very important that you do this, and it makes such a huge difference. The main thing why a lot of people don't do this is because they feel, but I can only put away 100 Rand a month extra or 200 Rand a month extra. What difference is that really going to make? So they don't do it because they think 100 Rand is so small that it won't actually make a difference. So I'm going to show you quickly, if we do an additional monthly payment. So again, I've used the same figures. We've got a bond of R1,000,000. It's at a 7% interest rate. Your repayments is 7,750 Rand a month. If you just add 100 Rand to that, you make it 7,850. You will drop your term over which you pay the bond with 7 years. 7 months. Sorry guys, I wish 7 years. 7 months. So 100 Rand makes a 7-month difference. That is a savings of almost 55,000 Rand over the term of the bond. For 100 Rand a month. Now I am 100% sure that there's not one of us that can't afford to just add an extra 100 Rand to our bond. If we can take that and make it 1,000 Rand, you then drop your bond repayment term from 240 months to 189 months. It's massive. That is a change of about 50 months. It's over 4 years that you save by just adding an extra 1,000 Rand a month onto your bond. Total savings that you have over the term, 400,000 Rand. That you are saving in interest and capital repayments over your term if you add an extra 1,000 Rand per month. So that's the first one. Start as soon as possible. Even if it's only 100 Rand a month, add that to your bond, pay it off a little bit sooner. It does make a huge difference in the long term. The second one, on the second strategy, you take an annual bonus, or you take your tax refund that you get, or maybe you sell something which is a capital amount that you're getting in, you can use that capital and put that into your bond as a once-off every year. So let's say, for example, you get a 13th check at the end of the year. Instead of using the whole 13th check for Christmas and your Christmas holiday, say to yourself, I'm going to take a percentage of that this year and put it into my bond. Whether that starts out with a 10% or a 20% or a 30%. And welcome back, everyone. Hungry Like the Wolf from Duran Duran. Those of you listening on Berg Studio, doesn't that bring back some memories? That's about, if you hear that song and you don't feel like you're back in the 80s, I don't know. A brilliant, brilliant song. So let's continue with our discussion on joint ownership of property. What are the risks and what do you need to look at when you decide to buy a property with a partner, whether it's a business partner or a romantic partner? So the next question is, but is it bound or free co-ownership? But it's more complicated than that. Our law recognizes. So before the break, we spoke about the fact that you as a co-owner has the right to withdraw from that property at any given point in time. But it's more complicated than that. Our law recognizes two types of co-ownership. And this is something I didn't know. I also learned about this now. It says in a free co-ownership, the co-ownership is the only legal relationship between the co-owners. In this event, the rule above applies. Either joint owner can assist on division at any time. So if it is a free co-ownership, any of the owners can ask to be removed from the property ownership. In a bound co-ownership, however, there's a separate and distinct legal relationship between them, of which the co-ownership is but one consequence. Co-ownership is not the primary or sole purpose of their relationship. So that means that the two people don't just have a relationship because they have bought the property. In this event, the co-ownership can only be dissolved when the primary relationship is terminated. In this case, the party opposing the court application said that no order of division could be made until the universal partnership between the parties have ended. So the universal partnership was the cohabitation relationship they had. The court then found that there had indeed been a universal partnership in existence. In other words, that this had been a case of a bound co-ownership. So it wasn't a free co-ownership where the one party can just say, I want to withdraw from the property. This was a bound co-ownership. But it also held on the fact that both the romantic relationship and the universal partnership had ended when the parties stopped living together. So when they broke up, the universal partnership also broke down. This romantic relationship was the tie between the parties, and when it came to an end, any situation of bound co-ownership became a free co-ownership to which the end at any time rule applied. So let's look at another scenario. You and a business partner, you buy office building for your business. That means that you have a bound co-ownership because you are business partners in a business, and through that partnership you decided to buy the property. So the property in its own sense isn't the only relationship that there is between you and your partner. That means you don't have a free co-ownership. So if you then stay in the business, you are still partners in the business. You cannot just decide that you want to remove your ownership from the property. But if the business partnership dissolves, you're no longer part of the business, you have removed yourself from the business, that bound co-ownership will then move into a free co-ownership, and you can then request to be removed from the ownership of the property. The result, the court ordered the joint ownership terminated and appointed a receiver and liquidator to sell the property. They also needed to pay all the property debts and divide the proceeds between the parties. Okay, so that is what happened in this case. But what happens if one of the parties pass away? So it's a joint ownership, but one of the owners pass away. So there's different scenarios that could happen. The first one is if people are married in community of property. So if you are married in community of property and your property is registered on both you and your spouse's name, it means that both spouses share all assets and liabilities equally. Whether you bought the property before the marriage or not, doesn't make a difference. The moment you are married in community of property, all assets are shared equally. If one spouse dies, the joint estate is divided equally between the surviving spouse and the deceased estate. So let's say you have a property, it's worth R1,000,000 and it is in both your names. If you pass away, or if your husband passes away or your spouse passes away, you immediately own 50% of that property because 50% of the estate is yours. The other 50% then needs to be transferred into your name for you to become the full owner. Okay, the surviving spouse will have a claim for half of the value of the joint estate, while the other half forms part of the deceased's estate and is distributed according to their will or the laws of intestate succession. So if there is no will, it will be according to the laws of intestate succession, which means the people put in charge of winding up that estate will find somebody who can inherit. However, in marriage of community of property, a third party cannot inherit a portion of the property from a person who dies while married in community of property. So what that means is if a husband and wife owns a property together, and they're married in community of property, the husband cannot go and bequeath his part of the property to his children or some other third party. That part of the property has to go to the other spouse. The joint estate belongs to both spouses, and the surviving spouse has a claim to half of the value of the estate. The deceased estate will be distributed according to their will or the laws of intestate succession, but any property that formed part of the joint estate will be subject to the surviving spouse's claim. So the surviving spouse, even though the husband might have decided to give his portion to his children, the surviving spouse will have a claim on that property, so it can't be registered then in the children's name. Okay, so let's look at married ANC with accrual. So this is an antenuptial contract with accrual. This means that each spouse retains their separate estate and property, which is not part of a joint estate. And each spouse has the right to deal with their own property as they see fit. So if a husband and wife are married ANC without accrual, each estate or each asset in each of their estates are completely separate. When one spouse dies, their property will be dealt with according to their will or the laws of intestate succession and will not automatically be divided with the surviving spouse. So the one spouse might own a property. That doesn't necessarily mean that the other spouse will get that property. Let's say the two spouses bought a property together, so they are joint owners of that property. Obviously, the share that is the one spouse's share, they will keep. The other share will then go according to that spouse's will. So if that spouse decides that they want to leave their share of that property to their children and not to their wife or their husband, that will then be registered, and that spouse will then have another partner in that property. So third-party inheritance of a portion of the property depends on the ownership of the property. If owned solely by the deceased spouse, a third party can inherit a portion of the property. But if jointly owned, the surviving spouse has a claim to their share of the property. and a third party would not be able to inherit that portion. Okay, so I actually got that wrong. So in that case, if it's a joint ownership, the spouse will still be able to inherit that portion, or have a claim to inherit that portion. If it is not jointly owned, the spouse can leave that property to anybody they choose, and the surviving spouse will have no claim to that property. That is very, very interesting. Then the next one we have is married antenuptial contracts. You have an antenuptial contract with accrual. So this is now with accrual, which means that each spouse retains their separate estate, but a joint estate is created during the marriage and divided equally between the spouse at dissolution. So what that means is that whatever assets the one spouse, let's call it the husband, whatever assets the husband had before he got into the marriage, and whatever assets the wife had before they joined the marriage, that stays their assets. Whatever they combine in the marriage, that will be divided equally between the spouses. So a third party cannot inherit a portion of the property from a deceased spouse. The joint estate belongs to both spouses and will be divided equally between them. However, separate estates can be inherited by third parties. So again, the portion of the estate that was put together when built up while the marriage was active, that will be handled like they were married in community of property. Any asset that the husband or the wife had before the wedding, that can be handled and inherited by third parties. But if they bought the property before the marriage jointly, and they then go into a marriage, each one's share of the property will still be separated into their own estates. If they then pass away, the other party, again looking at that previous discussion we had, the other party will then have a claim against that estate. So or against that property. The next one we need to look at is what happens when an unmarried person dies. So when an unmarried person dies, their property will be distributed according to their will or the laws of intestate succession. Third parties can inherit a person's property if named as beneficiaries in their will or entitled to inherit according to the laws of intestate succession. So obviously, if a person is not married, they pass away, that property has to go to some beneficiary. And this depends on the person's family situation. A will allows specific beneficiaries to inherit property, whether related to the person or not. Again, when that person has bought a property jointly, that will then be handled according to the previous discussion we had. And we'll get to that point now. So when two people are not in a romantic relationship and they buy a property, how does it get handled in that case? So before we get to that portion, let's do a short music break again. And those of you watching on our YouTube channel, we are going to continue watching the video on paying off your bond in half the time. If you have any questions or any comments, you are welcome to WhatsApp me on 082-801-6693, or you can send me a message through our Berg Studio online portal. You just push the shout out button and I will be happy to answer your question in studio. Let's continue with the video on paying off your bond. You put that towards your bond, because that capital that you put extra into your bond immediately reduces the outstanding capital and reduces the interest that you pay. That's also why it's very important. What we teach in our coaching with our students is firstly to take control of your cash flow so that you have positive cash flow available, of which you can then put a portion towards your bond. Secondly, to have your capital expenditures planned up front. through your reserve account. So the reserve account then has a budget for all your annual expenses. So if you get a bonus at the end of the year, you've already planned for the end of the year expenses, the Christmas presents, the holidays, etc., etc. So that bonus, that 13th check, you do not need to use for that. So you can put a big portion of that towards your property. So let's say, for example, you get a bonus and you can add 15,000 Rand at the end of the year additionally into your bond. If you do that every year at 15,000 Rand, that will bring your bond down to 180 months instead of 240 months. It's a 5-year improvement on your bond. The total savings over the term of the bond works out to 472,000 Rand. 472,000 Rand savings by taking a portion of your bonus every year and just adding it into your bond. Again, when we look at access bonds, which I believe everybody should have some kind of an access bond, even if you do that and you put it into the bond, that doesn't mean the money is now gone and you can never access it again. If there's an emergency, you will be able to access that bond again. So those are the first two strategies. The first one is just take a little bit of extra cash flow and put that towards your bond on a monthly basis. You can do that by either just paying it in. A lot of the banks allow you to just do a transfer on your online banking extra, or you can even talk to the bank and ask them to increase your debit order that goes into your bond. Secondly, you can take your annual bonus, your tax refund, and make annual payments. Once a year, you add an extra capital into your bond, which will make a huge difference as well. So we've done 2 strategies so far. We've said you can pay a little bit extra every month, as much as you can. But every little bit helps, even if you can only add 100 Rand a month. Secondly, make annual payments. If you get a bonus, if you get a tax refund, take that money and put it into your bond. Preferably make sure that your bond is an access bond, so that you have access to that money again in case there is an emergency. So what is the third one? So the third one is something that very few people actually think of, and it is one of the most powerful ways to pay off your bond. And how that works is, if we look at life, if we look at inflation, every year everything goes up. The food goes up, our groceries, our water and lights accounts, electricity goes up. All of these things increase every year. Our short-term insurance increases. Welcome back, everyone, and that was George Michael with Faith. And those of you on social media, you watching how to pay off your bond in half the time. So we are about halfway through that video. I think you probably have heard about 2 of the 4 strategies. So if you want to learn about the other 2 strategies, you are welcome to go to our YouTube channel. Just search for iRetire, and you will get all our videos on there, including this one, which will be under our live streams. So before the break, we spoke about what happens when people are married, they own property jointly, and they pass away. Let's now talk about when 2 people are not in a romantic relationship and they own a property jointly. There are 2 possible ways in which the property could be owned, either as joint tenants or tenants in common. So this is quite interesting. When I did my research, this was something that I wasn't aware of, and that is very interesting. And I think a lot of people who own property jointly don't even think about making a note of this. If the property is owned as joint tenants, upon the death of one of the owners, the surviving owner automatically becomes the sole owner of the property. So if people are registered as joint tenants when they buy the property, even if they're not in a romantic relationship, they are not married, and the one owner passes away, the surviving owner automatically becomes the sole owner of the property. This is because the principle of survivorship applies. which means that the surviving joint owner acquires the shares of the deceased joint owner by right of survivorship. In this case, the deceased owner's share does not form part of the estate and cannot be disposed of in their will. So that is very, very interesting, and the implications of that is far-reaching. On the other hand, if the property is owned as tenants in common, each owner owns a specific share of the property, and upon the death of one owner, their shares will be dealt with according to their will or the laws of intestate succession if they did not have a will. So in this case, shares form part of their estate and can be disposed of in their will. So if the deceased owner did not have a will, their share will be distributed according to the laws of intestate succession. So in this case, if you and a partner buy a property together, you are registered as tenants in common, that his share will go into his estate and be dealt with according to his will. It is important to note that if the owners have a written agreement that governs the ownership of the property, the terms of the agreement will take precedence over the default rules of joint tenancy or tenancy in common. So you can override these rules through a proper agreement that you draw up before you buy the property. Therefore, it is important for the owners to have a clear understanding of their ownership structure and to have a written agreement in place if necessary. Always important, get your written agreement in place. If the property was purchased while the owners were in a romantic relationship and the relationship then ends, this happens a lot, either through a divorce or either through a breakup when two people weren't married but they were cohabitating. But they continued to own the property jointly. Then the property will be dealt with according to the ownership structure in place at the time of death of one of the owners. So this is now in the case that you and a partner, you were in a romantic relationship, you bought a property together, you then broke up, but one of you maybe stayed in the property and the other person kept being a owner of that property. What happens if one of you pass away? If the property was owned as joint tenants and one owner dies, the surviving owner will automatically become the sole owner of the property. So guys, this is important to go find out. If you do not know whether this is the case, it is important for you to find out. If the property was owned as tenants in common, the deceased owner's share of the property will be dealt with according to their will or the laws of intestate succession. However, if the property was owned as joint tenants and the owners subsequently changed the ownership to tenants in common, so you moved it from the one to the other, then the change in ownership will need to be recorded with the deeds office to be legally valid. So guys, if you see that the way that the joint ownership is set up at the moment is not correct, you can change it, but it needs to be recorded with the deeds office. So you need to go see an attorney, get them to make those changes and record it at the deeds office. If the change was not properly recorded, the ownership structure in place at the time of the death of one of the owners will be used to determine how the property is dealt with. So don't wait for something to happen. Find out what's going on now. If you are in this situation, go make a phone call, find out what's going on, and then from there, go and get it sorted out. In any case, it is advisable for individuals who own property jointly to ensure that the ownership structure is clearly defined and recorded with the deeds office, and that they have a valid will in place to ensure that their wishes are carried out in the event of their death. So guys, we're going to talk a little bit about some suggestions now if you are looking to buy a property jointly or have already bought a property jointly. But it is advisable to first find out, make the changes at the deed office, and also get your will sorted out. If you do not have a valid will, you don't have advice on how to set up your will, be in contact with our office at 087 809 0603. And one of our will specialists will be in contact with you, set it up so that you have a valid will in place. So let's look at the remedy. What do you do to make sure that you mitigate these risks? So there are risks involved when buying a property jointly, and it's important for you to mitigate those risks. Happily, however, there is a simple remedy. Before you buy property jointly, have a professional draw you a full agreement setting out at the very minimum the following. Number one, the nature of your relationship. In a cohabitation scenario, you should probably also have a full cohabitation agreement, not just relating to the property, but in general, what are the cohabitation agreements you and your partner have? Whilst the business scenario should be linked to your existing arrangement. You need to discuss the best vehicle for co-ownership. For some, a simple let's put the house in both our names will be enough. For others, you might want to consider putting it into a company or maybe a trust. The next one is who will own what percentage of the property. So it doesn't have to be a 50-50 split. It can be 60-40, it can be 70-30. You need to discuss who will own what percentage of the property. The next one, who will contribute what to the cost of purchase and to the property expenses and upkeep. So who will contribute what? The next one, who will have what use of the property? Are you both going to stay there? Are you buying the property jointly but only one person stays there? Or are you using it for a business premises? What will the use and which of the partners will have what use of the property? The next one, what will happen if one or both of you wants to leave the relationship? If one of you passes away or is incapacitated, what happens to that property? So every situation will be unique. So you have to sit with a legal expert and get these things done. If you have such an agreement in place, you could save yourself future stress if the relationship breaks down, wasted time, the hours and hours of wasted time arguing, going to court, etc., etc., and legal costs of a protracted and complex dispute. So guys, a little bit of time, money and effort up front can save you thousands of rands and wasted time at the back end. You could also avoid liquidator or receiver's charges for having to sell the property if you just set it up correctly up front. Okay, so a final thought before we end. Having a formal contract in place is not a forecast that things will go wrong. So a lot of people think that if we have to already start talking about what will we do when things go wrong, before we even go into this partnership, then it shows that things will go wrong. We don't have a trust in this relationship, or we don't believe in this relationship. That is not the case. It should greatly reduce the risk of any dispute or unhappiness arising in the first place. So don't look at it as we don't have belief that this partnership will work. Look at it as a way to protect both parties while you are still looking out for each other's best interest, to make sure that there's a much reduced risk of unhappiness or stress if something does go wrong. Okay, guys, that was our show for today. I really enjoyed sharing some of this information with you. I've also, as I did my research, I also learned a hell of a lot about jointly owning property. So if there's anybody that you feel is in this situation, considering being in this situation, and needs to get this information, please refer them to this video. It is on our YouTube channel. It will be on our Facebook as well. You can look at our Facebook under Retire Happy. You can look at our YouTube channel, I Retire. You will find it there under live streams. Share it with as many people as possible. The more people you share it with, the more people can benefit from it. Thank you for joining me this morning. I really enjoyed it. Those of you on Berg Stereo, we're going to play out with one song. And those of you with on our social media, we're going to play out for the next 9 minutes on paying off your bond in half the time. Enjoy the rest of the week, and I will chat to you again soon. Cheers, everybody. Our medical aid increases, our long-term, our life cover increase, everything, all our expenses increase, our salaries increase. But what do? We tend to pay the same amount on our property for 20 years. So what we suggest with the third strategy is to look in the month that you get a salary increase. You take a portion of that salary increase and add that to your bond repayment every month. So let's say, for example, you get a 10% salary increase every year. You can then take 7% of that 10% and add that to your bond repayment. Because what that does, even if you do 10%, it basically puts you in a cash flow neutral situation. Because if your income increased by 10%, your bond repayment increased by 10%, the ratio stays exactly the same. What I just want to suggest is that you do this immediately in the month that you get your salary increase. That first month where your salary is higher than it was before, you want to implement that change immediately. Again, you can go talk to your bank and ask them to increase your debit order so that you get used to that expense. The problem is, if we don't do it immediately in that month that we get our increase, our expenses tend to expand and it swallows that increase, and before we know it, we won't be able to do it anymore. They estimate that any salary increase, any new job that you get to with a higher salary, within 3 months, your expenses have absorbed that salary and it hasn't made any big difference to your life. You're in exactly the same situation as you were in before. So let's have a look at it. So let's say, for example, we have the same scenario we've been working on this morning. R1 million bond, 7% interest, repayment of 7,750 Rand a month, and you increase your repayments with 7% every year. So the moment you do that, your bond repayment goes down from 240 months to 136 months. So that is huge. It is 105 months difference. That is almost, 4 years, almost 10 years, about 8 years, 9 years difference that it makes. The total savings over the term of your bond is 813,000 Rand that you are saving by just increasing your bond repayment with your salary increase at, say, 7% every year. That's huge, and not a lot of people think about doing something like this. So how do we then pay off your bond in half the time? We take a combination of all of these. The first thing is, let's say you add an additional payment of 500 Rand a month. You also add in 12,000 Rand as a lump sum or a once-off payment every year into your bond, and you then increase your bond repayment by 7% every year. So the moment we do that, we have reduced your term from 240 months, which is 20 years, to 117 months, which is just under 10 years. So that is exactly half the time. And it's as simple as that. You take 500 Rand a month, you put 12,000 Rand per annum. You can also change it around and put 1,500 Rand a month and no lump sum, but that's up to you. 12,000 Rand per annum is a lump sum, and you increase your income by 7% every year. Not your income, your payment on your bond by 7% every year, and you have paid off your bond in half the time. Total savings over the term, 961,000 Rand. That's almost a whole new property that you could buy with that money that you've saved over the period. So yeah, it's as simple as that, guys. A couple of things that I want you to really think of when you start looking at buying a property, and if you've already bought a property. The first one is, when you start planning to buy a property, you need to find out all the expenses related to that property when you do your budgeting. Don't just look at what your bond repayment is going to be. Make sure that you understand all the hidden expenses, the rates and taxes, the extra maintenance that it's going to cost you to maintain that property, the insurance that you have to take out on that property, the building insurance, the homeowner's insurance, as well as life insurance that the bank might expect of you to cover the outstanding loan. All of that are extra expenses that you need to look at when you decide if you can afford this property or not. One of the things I want you to also keep in mind is when you do buy a property, the banks very often add homeowners insurance to your property. So the first thing you need to understand is there is no obligation of you to take out that insurance through the bank. So firstly, yes, the bank can make it compulsory that you have the insurance. In actual fact, all banks will make it compulsory that you have homeowners insurance on that property, because they need to make sure that if something happens to that property, it is insured, because that asset underlines the debt. But there's no obligation on your side to do it through the bank. So firstly, shop around with your homeowner's insurance to get the best premium. Most of the time, if you add your homeowner's insurance to your existing short-term insurance policy, your existing household contents vehicle insurance policy, it will be cheaper than what the bank will charge you for that insurance. Secondly, if the bank does it, very often I've seen it that they do it as an annual payment. So they take that insurance not on a monthly basis, they do it annually. So let's say, for example, the insurance is 1,500 Rand per month. They will then add it as an 18,000 Rand annual premium. And then they add that annual premium to your bond every year. So the problem with that is, again, if you look at the way interest is calculated on your bond, you are basically adding 18,000 Rand debt to your bond. That goes to the outstanding balance. And then what happens is you pay interest on that insurance premium, which is not something that you want to do. So you always want to have that as a separate payment from your bond. It has to go off your normal bank account, whether it's through the bank or whether it's as part of your normal short-term insurance. So guys, have a look at that. Make sure that you don't have that as part of your bond and are paying interest on your insurance premiums. Secondly, a lot of the banks offer you life cover. What we usually suggest is that you look at that life cover as part of your holistic portfolio of risk benefits, not to take out a specific policy at the bank, because what typically happens is a lot of the banks give you a decreasing cover facility, which means you pay more and more and more every year, but your cover reduces because all it does is it settles the outstanding balance. So it becomes a very expensive kind of insurance that they put on. A third thing that I want you to keep in mind when you do look at these kind of things is get insurance where you are properly underwritten at the moment of inception. What that means is if you take out the insurance, go for the medical tests, get the blood tests done, make sure that the insurance company has underwritten your risk at the start of the policy. These policies where they say you don't have to go for any medical tests, you just answer like 10 different questions, those are problems waiting to happen, because they then underwrite at claim stage. When there's a claim, they'll look at those questions you answered, and usually it's like a quick no, and then they pick up something like you had high cholesterol or you had a heart attack or whatever, and you haven't declared it in those quick questions, because usually we typically don't even read those questions, and then it becomes a problem, and you are not there to defend yourself, you are not there to fight on behalf of your family, and then it becomes a huge issue. So make sure that when you do this risk cover, you get properly underwritten from the start. Okay, so just to look at planning for a big expense. The first thing you need to understand, if you are in the market to go buy a property, you maybe want to buy your first property, how do you know that you can afford it? The first thing you need to understand is that it will be much more expensive to buy a property.
Financially raw, real, authentic wisdom with Lourens from